Well, holy smokes, everyone. This is a game changer in terms of what we just saw on Micron's artificial intelligence revenue and what it means for GDP, as well as what we just heard from China. But let's start right at the top. Also, small note, I'm at an event, so I'm only going to be able to go live for the Market Open live stream for a few minutes today so we can hit the Q2 GDP data, which is old news anyway, the unemployment claims and some of the other stuff. We'll cover that. But right now, I want to talk to you about these Micron earnings that are sending the market to new highs. It's crazy. They're actually pretty good. I'm going to give them this. This is pretty good. There is a warning in them. We're going to talk about that, and then China. Let's hit it. So first, something to know about artificial intelligence. Artificial intelligence right now is estimated to make up in 2024 somewhere around $100 billion in United States GDP. That's not going to be global, that's just US GDP. Throw that into about a $24 trillion economy, and your contribution from artificial intelligence into GDP is about 0.4%, which is actually pretty good because it could be the difference between being positive or negative. Of course, right now, the Atlanta Fed thinks that our GDP is sitting at 2.9%, which is actually also really good. We've had a Jerome Powell who's told us, we should be growing at a below trend growth. And quite frankly, we're growing above trend right now. Maybe we're just above trend by 0.4 because of artificial intelligence. Either way, GDP looks good so far, and artificial intelligence spending is definitely contributing. Now, if we were to only hang our hat on GDP and or on artificial intelligence and everything else was flat, well, we would only have a GDP of about 0.4%. Again, artificial intelligence only making up about 13% of our GDP. Most of our GDP is really made up by you, the consumer. So this is an important contributor nonetheless, especially when Micron pulls off what they just did. Now, something to know about Micron that's really interesting before I tell you what they just pulled off, which you maybe have already heard about a little bit, but something to know is this is a cyclical company, which means you go through really rapid boom and bust cycles. Just to let you know how extreme those boom and bust cycles can be. This same quarter that we just reported last year, Micron lost $1.4 billion because the memory market went to trash. Their gross margin was negative 10.8%, which means they were selling their chips for less than they were worth, mostly memory chips. And now, in part thanks to their artificial intelligence chips doing well for now, of course, until competition picks up, which there's a warning coming up in just a moment, and this is from them, not from me. Right now, their margins are really excellent because, quite frankly, on their high bandwidth memory products for AI server and in data centers, they're sold out for 2024 and 2025, which when I first read that, I'm like, they're sold out for 2 years. But then I'm like, this year's already almost over. So they're sold out for about 15 months, which is good. They've already got that pricing set for that. Doesn't mean orders can't cancel, but it's certainly a good sign. And their gross margin this year is 35.3% on this quarter, which is up from last quarter by like almost 9 percentage points. Actually really good. So this quarter is a smoking hot quarter. Really great quarter. And so the question is, will that last? Is this a good time to invest in Micron? So one thing I looked at is their guidance. For the next quarter, they beat on EPS guidance by 14%. They beat on revenue guidance by 5%. And this quarter, they beat margin by 5%. So they're beating expectations, doing very, very well here. If I read out some sections of their earnings call, they say from a demand perspective, they expect that server demand will continue. They expect AI servers to continue to be strong this year and next year, and they don't see any change in that. They think the AI momentum continues, and they're hoping to get some modest growth in general purpose servers. That's where you definitely have a lag. PCs, smartphones, servers, kind of the consumer side, a little on the soft side, but those AI servers definitely cranking. In terms of demand, definitely strength in data center is driving upside to what we had communicated prior on our prior guidance. We continue to see really strong demand from our data centers. The demand is coming from both cloud and enterprise AI servers, as well as, of course, to some extent, traditional server origin. That's because that creates a certain base of their revenues, the traditional servers. But most of that extra demand that's making the difference here is, they said it, cloud and enterprise. So remember, Google, Microsoft, Amazon, Meta. These are the companies that are like, we will buy AI server chips and build out AI infrastructure at any cost because we will not be left behind, even if we lose money for a while. That's like what Mark Zuck said, you know? Zuck's like, yeah, you know, we're kind of known for doing unprofitable things for a while, and eventually we're turning profitable. Fair. Okay, so what warning did they give? Well, the first hint that they gave for a warning was actually in the face of very good news, which is we've seen very high demand for our product, and we feel confident in our ability to ramp. I mean, all of that ramp we have for 2025 is really limited by supply. And then they start talking about competition. So I always find this a very interesting one, because when you start talking about, oh, we're supply limited right now, what you're really suggesting is, hey, we're in a place where we're able to pull these high margins because there is limited supply, which is fantastic. Don't get me wrong, like milk the margins while you can. It just does give a little bit of an awareness that where the company says, look, there's gonna be a reason why we're not gonna guide into 2026 here, because prices could collapse as supply ramps up. And they're blowing money into CapEx. In fact, their free cash flow is only somewhere around $200 million. I want to say that was for the year, but let me double check that really quick because I have the cash flow statement right here. Sorry, I'm at a conference, and that's why I'm not going to be able to be live at my normal time today, and I snuck away into one of these little boardrooms over here just to make sure we can chat. Okay, here we go. Expenditures for plant, property, and equipment, $8.3 billion, blowing money into CapEx, capital expenditures, so they can continue to manufacture more. And 8.5 in incoming cash flow. So really very, very little actual free cash flow, which is not a surprise. They are a manufacturer, so this is they have their own fabrication plants. This is not like an NVIDIA. They actually conduct the R&D and they manufacture. So this is not like a high margin NVIDIA where you just send it all to TSMC and you take your 70% gross margins, which is one of the reasons NVIDIA is just such a sexy stock. That is for the year ended. Yeah. So basically no free cash flow for the year ended. Now don't worry, their balance sheet is acceptable. They have enough cash and short terms to cover their short-term debt. And then frankly, they have enough receivables and inventories if they sell that inventory at full price to cover their long-term debt. So their balance sheet is just fine. Obviously, their margins are excellent. This is a cyclical business, and they think they are very well positioned from a competitive point of view. However, they do also make it clear, they're asked, hey, so you feel pretty good for fiscal 2025. You just don't want to set the bar and be accountable to that bar, but you feel pretty good. Is that a fair way of summarizing everything you've said? Asks an analyst. The VP and CFO says, we've given some positive indications for the year, and we're vigilant at all times about our cost structure, about our cost performance, and the discipline of our capital spend, and maintaining stable share. And we think we're doing a good job of executing well and managing the risks. Okay, got it. So what are those risks? Well, overspending, collapsing the prices in the chip market, and then competition taking your margin away at the same time as you now have way too much excess supply. So it kind of makes sense why, like, let them bask in their glory a little bit. This is great news, okay? It's pumping the entire AI market and pre-markets, and you would expect that. Dude, it's like 4 a.m. This is ridiculous. I'm East Coast, so but, I came here from Cali. But I'm just looking at my clock going, oh my gosh, I'm already in a suit. Oh no. But anyway, it's really good. At the same time, now you've got China. They held a meeting with their Politburo, and they're talking about trying to stop the fall of home prices. They're going to stop the oversupply of new construction. That's something you should really tell Austin and Texas as well. Like maybe if y'all stop building as much, you wouldn't have as many issues. But anyway, and they are potentially planning some local municipal spending as well as consumer additional fiscal spending to help the consumer of about $284 billion. So it seems like on a daily basis here, they kind of see the market pop up a little bit on these stimulus ideas. And then they're like, all right, got it. Yeah, the market wants stimulus. Let's give them more. So it's good. I mean, it's a wonderful thing for markets on this. You've actually got oil. I mean, I don't think oil is moving on China here. It's probably more of a Saudi Arabia issue. Gold, though, going over 2,700. Bonds relatively stable and pre-market. Nasdaq's up 1.5%. Dow and S&P also pretty positive. I think the only thing that can really screw this up is in a couple hours, we'll be getting unemployment claims data. That is such a lagging indicator. I can't imagine that's bad. We get Q2 GDP. Who gives a flying F about Q2 GDP, third revision, price index, GDP, whatever. You will get durable, good manufacturing reports and some other data. I'll cover that when the time comes. But in the direction of artificial intelligence, if Micron's any guide, there's no slowdown here. Maybe there's some cheap opportunities for you to take advantage of. And keep in mind that this is, AI can boom and you can still have a recession. But it definitely helps. Like not having AI, you'd still be at 2% GDP. It'd still be over 2% GDP. So you haven't actually seen that translation to substantial weakness just yet. Of course, as I've maintained for a while, many of the leading indicators suggest we might be, one large shock away from substantial layoffs, and then your consumer gets crushed and then you're in a recession. But then again, that could be true at any given point in time. Of course, I do think we're in a particular position now where some of the indicators of recession are more numerous than I have ever seen in my career, which makes me a little bit more, dare I say, nervous and watchful. But consider it, it's not just the SOM rule, it's not just the 10-2 inversion, which usually when we get to 50 to 90 basis points, that's when the recession starts. Okay, we're at like 20 basis points inverted right now. But it's also the peaking of government payrolls, following the peaking in privates, delinquencies in consumer loans, credit card loans, the decline in the personal savings rate. It's not good, now under 3%, which is terrible. At the same time as incomes are only rising somewhere around 1%, not good. Architectural buildings down, ISM manufacturing down, ISM services above 50, but very, very low relative to normal boom times. Construction spending month over month down. Pricing power at companies outside of AI substantially down. You look at construction job openings rapidly falling. Temp hiring, longest stretch of negative readings. Jerome Powell's warning, we seek no further cooling. And they still only went down 50 basis points. I think they got to surprise cut down 200 to... honestly, that would make me very, very bullish because then they might actually avoid a recession. Beige Book, 9 out of 12 districts, flat or declining. The Challenger report showing the slowest hiring since August of 2009. The number of unemployed for 27 weeks or more, never increasing consistently absent a recession. It is. The Restaurant Performance Index sitting under 98, which only occurs in a recession. So, I mean, I hate to say it, but when you put that list together, it just doesn't sound that sexy anymore. But hey, in the short term, the euphoria can march on, which is fantastic. I mean, good. Go make money. Take profits as you feel comfortable or don't. And I love y'all. Thank you so much. If you want personalized financial advice, something catered to you for how to build wealth in real estate, stocks, or otherwise, make sure to sign up at stockhack.com. We're booking up our Calendly. You're welcome to join in there. You could get a free intro call. And then, of course, if you're interested, you could also directly sign up and get yourself on the calendar so we can start working for you. Check it out at stockhack.com. We'll see you in the next one, folks. Thank you so much. Goodbye and good luck.